Live from Tokyo, this is Insight with me, Sherry-Ann, where we dive deeper into the stories that matter with crucial context and analysis. Alibaba and other Chinese tech stocks fall sharply with President Trump's latest directives against China, stoking fears of a decoupling between the world's two largest economies. Despite the hugs and handshakes between Trump and Macron, the growing rift was evident as Washington breaks with European allies on Russia and Ukraine. Profits as Australia's largest oil and gas producer more than doubled on record production last year. We hear from Woodside CEO Meg O'Neill in just a few minutes on her outlook. But this is a picture across markets in Asia. We're seeing broad downside and really that lead lower by Chinese markets, with the Hang Seng Index at one point seeing its worst day in about 3 months. Of course, we heard from the Trump administration that we could potentially be seeing more efforts on tariffs against China, but also when it comes to CFIUS and really reining in Chinese spending on technology. And Bloomberg now learning that we might see more efforts that began under President Biden's administration when it comes to chip controls against Beijing. We are now seeing the Japanese market also back from holiday, seeing its worst day since November. We're watching Tokyo Electron on those potential chip curbs and chip restrictions that might see on their business in China. And the Japanese yen right now holding steady, as we're also watching the Korean won after that cut by the Bank of Korea. But let's get more on the markets with Andy Budden, Equity Investment Director at a Capital Group, which manages over $2 trillion in assets. And I think really the big news, Andy, is what's happening with the Chinese stock markets. Alibaba also following the ADRs that we saw on Wall Street lower today. What is this? Is it a market blip given the trade risks, the geopolitical risks? Or because we at one point thought that animal spirits were perhaps back here to stay?
Yeah, good morning, Sherry, and thank you for the opportunity to be here. So, yes, markets are down in China this morning, but actually they've had a pretty good run really since the DeepSeek announcement, and we've seen a lot of AI-related companies perform pretty well since then. And that's one of the reasons why the H shares have done rather better than the A shares just recently. But the one thing we can be sure of with China and Hong Kong is there's always going to be volatility. And in the short term, absolutely, geopolitics, tariffs are definitely going to take the wind out of the sails of China and Hong Kong. And of course, there are longer term challenges as well. I mean, China is entering the next chapter of its economic growth. It's likely to be slower. It's going to be struggling with demographics, struggling with the property sector and also quite high debt levels. So far it sounds quite negative. But I'd also say that for a long-term investor who focuses on individual businesses, actually the opportunities in China are really quite attractive. Certainly AI-related businesses, but also companies across a number of different industries that really cater to the increasingly sophisticated needs of a Chinese consumer.
We saw today also China holding their loan prime rate steady, so we haven't seen necessarily another move by the PBOC either, and commercial banks really following just what the central bank is doing. What does that mean for the broader levels away from the fundamentals of just a few companies? Our question of the day, for example, today is, will we see Chinese stocks entering a bear market at this point?
Well, once again, Sherry, whilst it might sound a slightly bland answer, the reality is that the one thing that we can be sure of with China is that it is going to be a volatile market. And I would strongly encourage investors to really think about which of the companies that will do well over the longer term. But of course, we absolutely are going to see a lot of news flow on tariffs, on geopolitics. Investors just need to be ready for that and stay focused on the long term.
Are those sectors that you think are going to do well centered around technology? We saw DeepSeek, for example, leading to that incredible rally in Chinese equity markets in the past couple of months.
Yeah, absolutely. So, I mean, I think that's very, very interesting to draw parallels with what we're experiencing today with artificial intelligence and actually what we saw in the early days of the internet. The early days of the internet, it was all about the on-ramp to the internet. And so companies like Cisco Systems, Juniper Networks did well. And today it's really about the on-ramp to artificial intelligence. So obviously AI requires vast amounts of processing power. We know what that's meant for the semiconductor companies in recent years and likely moving forward as well. But an area we're particularly interested in is which are the companies that are going to be first to be able to use AI to actually make existing products and services better. So really extracting greater productivity out of their existing products. And I think that's a really important opportunity for investors to focus on. And in fact, that's really what drove those important AI-related stocks in China over the last couple of months.
Andy, we want to continue this conversation. Andy Budden of Capital Group sticking around for us as we check the broader markets as well, and commodities, of course, one of those sectors that gets influenced a lot by Chinese demand outlook and the Chinese economy overall. In today's session, we're seeing a little bit of upside given fresh U.S. sanctions on Iranian oil, the Trump administration's latest trade moves, of course, but most importantly, really, the U.S. slapping more curbs on brokers, ships, and individuals that it said were linked to illicit shipments of Iranian crude. We're also watching, of course, one stock very closely, Woodside, right now trading to the upside of more than 2.5%. The company just reported full-year earnings and underlying profit that were in line with analyst estimates. Its final dividend was also slightly stronger than anticipated. For more on this, let's bring in the Asia Trade co-anchor, of course, Heidi Stroud-Watts, joining me now, who's standing by with our next guest. Heidi.
Sherry, good to see you again. And yes, I do have my next guest with us ready to give us a little bit more sort of elucidation around everything that's really impacting commodity markets and LNG in particular. Meg O'Neill is the CEO and the Managing Director when it comes to Woodside Energy. Really great to see you again, as always. And, you know, we were just talking through some of those numbers and how impressive this period was. There's a lot of uncertainty when it comes to pricing, right? Because in European markets, in Asian markets, prices are still sort of more on the higher side than you would expect. How much is sort of the geopolitical tension aspect and some of those uncertainties weighing into the outlook? And I guess what is your outlook when it comes to the pricing dynamic for the rest of the year?
Well, thanks for having me on the program. It's always a pleasure to be here, especially after we announce a particularly strong set of results, $3.6 billion net profit after tax, allowing us to pay 80% to our shareholders, 53 cents per share. So great outcome for everybody who's invested in Woodside. Now, when we think about the pricing environment, one of the things that's really important for us as we think about investments is the very long-term horizon. And the long term, in our view, is quite stable. We still see the main factors: population growth, global economic development. All of that means more energy is required. And as you start to explore what energy commodities are going to meet that growing demand, LNG is going to play an increasingly important role. Now, of course, in the very near term, there's quite a bit of volatility. We've had a volatile last 4 years between COVID, when economies were shutting down and prices were depressed, all the way to 2022 when Russia invaded Ukraine and we saw price spikes, particularly for natural gas. The last couple of years have been what I'd call a normalizing period, and we're seeing that extend into this year as well. But the one thing that's proving to be a little bit unpredictable is some of the changes that are coming out of Washington, and what does that mean for the energy sector? So tariffs, sanctions, peace deals, it means it's a little bit difficult to predict. So the things that we focus on are the things we control, continuing to get value out of our world-class assets, managing the costs that are in our operating business, ensuring that our marketing team is ready to take advantage of the volatility that presents itself, and ensure that we can continue to deliver value to our shareholders through the cycle.
When you take a look at some of those various uncertainties, and a lot of it is coming from the US, right, be it trade tariffs that might impact growth and demand from key markets to potentially the return of Russian energy supplies, right? What is the biggest kind of impactful piece when it comes to the forecast going forward, do you think?
Yeah, probably a couple of key focus areas. One is a question around Russian gas, which we watch very closely. Certainly the infrastructure that used to take Russian gas to Europe, not all of that infrastructure is available anymore. And the European appetite for more Russian gas, I think, is tempered versus where it was in 2021. We look at the rate of other LNG developments, competing projects. One of the things we're seeing is a lot of slowing. So whilst our Scarborough Energy project, for example, which is to develop LNG here in Australia, is on track, many other projects are experiencing delays. We look closely at OPEC. So oil price is also important, not just for our oil business, but also for our LNG business. And in that space, we look at things like what's OPEC doing around potentially putting supply back to market, but also what's happening with sanctions both on Russia and places like Iran. So a lot to keep track of in our world. And I do expect it'll continue to be a volatile year.
How do you factor in all of these different scenarios in order to calculate your CapEx for the next few years? What are the major factors that will be impacting your decision?
Yeah, so a lot of the capital program that we're in the midst of. So once you take an investment decision on a project, you really need to see it through. And so we do a lot of work before we take those decisions to ensure that we have the balance sheet capacity and the financial strength to be able to see those projects through, even if there is a price shock. The biggest decision ahead of us this year is a decision to invest in a Louisiana project called Louisiana LNG. It's an LNG development, obviously in the state of Louisiana. We've got the technical work well matured. We've got Bechtel lined up as the contractor. We have a signed priced agreement with them. We're in the process of bringing partners into that development. And so we want to be ready to take an investment decision, from the first quarter of this year. And again, those are the sorts of decisions where we need to make sure we've got the financial capability to see the investment through.
When it comes to the Louisiana LNG project in the U.S., does that affect your Commonwealth LNG project down the road from you? Will there be an impact to this plan, and will you still be buying gas from them?
One of the things that we're trying to do at Woodside is to become a more globally impactful LNG player. We've used the phrase LNG powerhouse in the past. Louisiana LNG helps us do that by having a material presence in the Atlantic Basin so we can meet the needs of European customers. That's nicely complements our Australian business, which has been providing LNG to customers here, particularly in Asia, for 35 years. Now, Commonwealth LNG, we've got an offtake agreement. We're not investing our own capital. If that project proceeds, we would be happy to take that LNG into our portfolio. We think the pricing is quite attractive. But the reality is our project is probably in a little bit better shape than many of the competing projects. We have all of the permits we need, all of the environmental authorizations. We have that priced contract with Bechtel that I talked about. We've already done quite a bit of work to de-risk the civils, which is where many Gulf Coast projects struggle. So I feel very good about the position we have both in Louisiana LNG, but happy to take offtake from others if the opportunity presents.
I'm curious, have you seen an uptick in interest when it comes to the Chinese market, particularly after the tariffs were put into US shipments?
Yeah, so the Chinese market is interesting. We have a very long-dated Chinese contract from our Australian business, and the buyer there has been a very reliable buyer that we've known for many years now. For our Louisiana LNG project, our focus much more is on bringing in investors in the project than trying to place LNG issue LNG contracts at this point in time. So whilst we do have quite a bit of interest in LNG contracts, our focus is on the sell-down parties. Look, I'm sure Chinese buyers will be in the mix. They have a preference for the very lean LNG that comes out of the U.S. But again, with the geopolitical tension, I suspect their appetite will be a little bit tempered in the near term.
Yeah, the demand side is also almost as as complicated as the supply side, right? When it comes to the slowdown in China, but then also the restart and build out of nuclear as well. How do you, I guess, envisage the slowdown of LNG demand across Asia, and how do you manage that trajectory?
Actually, our view is that LNG demand in Asia will be increasing, and you don't have to look much farther than comments made by the Indian petroleum minister, comments made out of Indonesia, a lot of Southeast Asia that has historically used domestic gas. Those resources are depleting. They're looking to import. Places like India, their appetite for energy is insatiable as their economy grows. China, you're right, there's probably a little bit of a near-term slowdown, but you look at the amount of coal that's used in China, to displace even 10 or 20% of that coal would represent a significant growth in LNG demand. So our base forecast has LNG demand growing 50% over the next decade. And we've got a lot of confidence that that's going to come to fruition because LNG just offers so many positive attributes. It's highly flexible. You can move it to where demand is at any point in time. It matches the seasonality. It's the best source of energy when it's cold, when, the wind might not be blowing and the sun might not be shining in those North Asian winters. So we've got a lot of conviction around LNG.
And to finish up, of course, it's an election year here in Australia. Regardless of who either retains power or is in power following that vote, I do wonder what sort of the key policy change when it comes to energy policy that you're looking for?
Well, the key thing in our mind is a couple-fold. One is to make sure that we've got clarity on where we want to go with the transformation of the energy system, and ideally that would be a common view across both parties, and both parties have affirmed a desire for net zero 2050. I think there's an opportunity in Australia to let the market meet the energy demand needs. We're seeing a lot of efforts from government to control what's in the mix and what's out of the mix. I think the U.S. is a great contrast. In the U.S., market forces have resulted in gas pushing coal out of the mix. It's resulted in emissions decline. It's resulted in more renewables investment. And that's just the capital markets doing what they do very efficiently. I think that's the opportunity for Australia. Streamline the permitting requirements, get rid of red and green tape, and let the private market come solve this very complex challenge.
Meg, always a pleasure. We appreciate your time today. Meg O'Neill, of course, the Managing Director and CEO of Woodside Energy, following those earnings. Sherry.
And of course, Heidi Stroud-Watts there in Sydney as well with that conversation with Woodside. But still ahead this hour, Germany voted for a change, but the new government has a busy road ahead. Jens Ruebbert from EuroCham Singapore joins us later with his insights on Germany's new political reality.
Medium term is going to be, increasing productivity, improving efficiency, widening application of AIs to consumer products and all other innovations and stuff. So that's all positive for growth, for earnings outlook. So short-term volatility correction, I think we are going to see it, but I don't think Chinese stocks are going back to a prolonged decline.
BNP Paribas Asset Management APAC Senior Market Strategist Chi Lo there. Let's actually bring back Andy Budden, Equity Investment Director at Capital Group. He's still with us. And of course, we're talking, Andy, about the attractiveness of some of those sectors in the Chinese market still, especially when it comes to tech sector, AI-related stocks. Are there any other parts of the Chinese stock market that you would like to invest now when valuations are low?
Yes. So, the comment I made earlier on was this idea of companies that really cater to the needs of an increasingly sophisticated Chinese consumer. And there's actually there's a bunch of different areas we find quite attractive. One would be healthcare. And I think that's an enduring opportunity. And in fact, we're seeing, several Chinese pharmaceutical companies which are now, potentially going to be having blockbuster drugs outside China. So very, very exciting times. Another one would be travel. The whole world, not just China, but the whole world is going through a transition where, folks like us used to spend most of our money on goods, on material possession. But increasingly, we're actually seeing that money spent on experiences. And so various travel stocks in China are pretty well positioned. And I'd say, actually, that's not just a China thing. That's really a global investment trend, this transition from spending money on material possession to instead experiences. So quite an exciting area for investing in.
And yet we aren't seeing those really aggressive moves coming from monetary policy. As I mentioned earlier, loan prime rates held steady by commercial banks. The PBOC still hasn't cut rates, which we're expecting earlier in the year as well. How much longer will investors have this much patience with the authorities in Beijing to do more to support the economy?
Well, I'm very confident that investors will be impatient and patience may run out. But I think it's very, very important to understand that the different authorities around the world do run their countries and economies really quite differently. Many of us who are used to developed markets, Western markets, will think about some of those prophetic statements about whatever it takes, which has come from monetary authorities in Europe, for example, back in the time of COVID and the global financial crisis. But actually, it's different in China. I think we anticipate seeing the Chinese authorities take a more measured approach where they gradually ease, where they gradually raise fiscal stimulus, just trialing how much is necessary in order to re-accelerate the economy. So it's just a different approach. Very important to understand that the world is not a single place, and there are different approaches in different countries.
And of course, we are watching, for example, Japan be one of the beneficiaries when it comes to economic fundamentals starting to change. And as you said, a lot of diversity when it comes to where investors can invest in. But at the same time, we are really seeing the downside from these tariff threats. Tokyo Electron today, for example, taking a hit on news that potentially they could get scrutinized when it comes to maintenance gear that they have in China as well. What do you think the fallout will be broadly across Asia, given all of these tariff threats?
Yeah, so once again, short-term news flow is absolutely going to be disconcerting. We are going to see a lot of swirl around these announcements, especially in the area of technology. Needless to say, I advocate a long-term approach, but I'd also encourage investors to remember that actually these periods of dramatic political, economic, trade change, invariably they create powerful secular trends. They actually create opportunity. And when we're thinking about Japan in particular, as you mentioned Japan, there are some really important changes. We have a couple of generations of consumers and company managements where all they've ever known is price declines. And inevitably, it's taken them time to figure out how they want to approach a world where, or a Japan where inflation is starting to stick. Another very important development in Japan has just been this long progression towards superior corporate governance. And we're really starting to see that having traction in Japan. And that comes in the form of more dividends, more stock buybacks. And it's fascinating to look over the last 10 years, that combination of improved corporate governance plus a little bit of Japanese yen weakness means that in Japan, companies have actually produced the same earnings per share as in America. So that's the power of corporate governance. So very important to think about short-term news flow, but also to think about these long-term trends like improved corporate governance can be incredibly rewarding for investors.
Yeah, Berkshire Hathaway wanting to increase ownership in the largest trading houses in Japan. But just quickly, what about the fundamentals that decide what the Federal Reserve and the Bank of Japan will do, especially with rate differentials and divergence around the world? How do you invest around that?
Yeah, so I mean, in the case of Japan, as I've hinted already, that it's clear that inflation is starting to stick, behaviour is starting to change, and we're seeing the Bank of Japan, continuing to be cautious, but likely on a path of gradually increasing rates and really normalising the way the Japanese economy works. I mean, you mentioned the Federal Reserve. If we move to the US, I mean, the US is clearly in a very different situation. We do have inflation likely continuing to moderate through the year, but also likely to reach a sticking point probably around about the 3% mark. And in the face of a continued strong economy in the US, that likely means that the Fed will be able to cut one more time, but then potentially even have to think about kind of hiking at some stage. Now, just to be clear, we would need to see more persistent, much higher inflation data for that to happen. But clearly things are starting to change in the US economy, especially on the trajectory of inflation.
Andy Budden, good to have you with us of Capital Group. You're still sticking around. We'll talk more about your views on the U.S. markets as well. Plenty more ahead. This is Bloomberg. Welcome back. You're watching Insight. We do have breaking news at the moment. We are now hearing that Tata Capital has approved an IPO, including a sale of 230 million new shares. That will include the IPO, will include OFS by certain existing holders, and this after we had been expecting some sort of preparation for an IPO of Tata Capital from reports starting in December of last year, and we had seen those shares of Tata Investment being supported since December, and we're now getting the latest that Tata Capital has approved an IPO, including the sales of 230 million new shares, this coming from a regulatory filing from Tata after those media reports surfaced at the end of last year, and we saw that Tata Investment being supported, as you can see, that blip in 2025. U.S. futures also supported in today's Asia trading session. This, of course, after a big sell-off overnight. We saw substantial declines in the mega cap sector. Investors really cautious given the policy uncertainty around trade, but also because we do have Nvidia earnings later in the week. Avril Hong is here to break it down, and expectations pretty high, Avril.
Yeah, the bar, as you know, is always high for Nvidia, but just looking at the performance in U.S. stocks overnight, because it was the worst 3-day showing in 2 months, NASDAQ hitting the lowest level in 3 weeks, that caution ahead of that big earnings event, as the company has gotten its limelight sort of stolen by DeepSeek and Alibaba this year. But even if it delivers a blockbuster report, it might not be enough to turn around the fortunes that we've been seeing for the Mag 7s this year, because the gap is still quite big. Now, it's not just about the caution ahead of Nvidia earnings. You think as well about the policy pronouncements from the Trump administration and how that's cast doubt on U.S. growth exceptionalism, given the investor caution and arguably some of this confusion as well. Flip the board. I just wanted to give you a further sense of how cautious investors have been. If you look at this chart courtesy of Goldman, it actually shows you hedge funds' net exposure to the Mag 7s. It's actually at the lowest level since April 2023. And it's not just about the Mag 7s. You think about some of these major firms that have raised concern about tariffs, about uncertainty, how that's chipping away already into their businesses. Thus, that then dent the economic resilience, which has been responsible for a large part of the U.S. stock rally. As Garfield Reynolds from the MLive team put it, investors might be misguided to think that the Nvidia event is this answer to whether the peak is in to the S&P 500. Flip the board again. I just also wanted to show you how that's kind of eating away at cryptos as well, because investors appear to be selling digital assets to cover their stock market losses. Bitcoin losses are deepening. This chart shows you as well the lows for the year, 89,000. Below that, we might see crypto capitulation, Sherry.
April there with a broader check of the markets and what to watch out, especially when it comes to U.S. equities, because we're still around record highs. But there are also growing questions about the sustainability of U.S. exceptionalism. Let's bring in Andy Budden, Equity Investment Director at Capital Group. Andy, thanks so much for sticking around. So where do you think U.S. markets go from here, given, as we mentioned, how overstretched valuations can look, especially in certain segments of that market?
Yeah, so ultimately what drives equity markets is earnings growth, and the outlook for earnings growth is over the next couple of years is pretty positive. I mean, the market overall, the expectation for earnings growth is in the kind of low to mid-teens. And what's very interesting right now, Cherie, is that yes, there's strong earnings growth expected from the Magnificent Seven and from tech stocks, but actually the earnings growth expected from the rest of the S&P 500 almost as fast as the Magnificent Seven. So we are finally seeing that rather wonderful market broadening. So a lot of very interesting opportunities for investors.
Where exactly are the opportunities at a time when we're also facing potentially more hits to consumers, given the incoming tariffs that could be a tax to American consumers? And of course, they're the biggest part of what drives the American economy.
Yeah, absolutely. So there is definitely going to be tricky news flow, and tariffs, geopolitics, all very challenging. But I mean, you mentioned American exceptionalism earlier on. I think that really is at the heart of this. And I do want to highlight It's a little bit early to start writing off American exceptionalism. It's something that's been with us, honestly, for 150, 200 years. And especially when you look at what are the foundations for the strength of the US. And the first foundation is absolutely productivity growth. And that's based upon this huge domestic market. It's also based on the US continuing to be really the global hub of innovation. You see that in all industries, but especially tech and also healthcare. But it's not just about productivity growth, which is accounted for 2/3 of economic growth since the Second World War. It's also about the fact that the US continues to offer a very attractive proposition for shareholders. It's partly because the financial incentives are very high. It attracts the best talent. It's also because management are actually really good at managing their share count carefully so they don't dilute shareholders. And also regulators in the US generally are quite pro-growth, especially compared with, for example, regulators in Europe. None of these characteristics look like they're changing. So this formula for American exceptionalism still looks pretty robust. But of course, the final thing I'd say, Cherie, is you do have to pay for it. The valuation on the US market is somewhat higher than most other equity markets. But even then, I'd say that for the discerning long-term stock picker, there's really interesting opportunities. Yes, tech looks expensive in the US. S&P 500, excluding technology, actually valuations are pretty much in line with historical averages.
Do you focus more on domestically oriented companies as well if you're veering away from the large caps because of valuations? And how does a strong dollar factor in here?
Yeah, so I think there's certainly a case for domestically oriented companies, and clearly part of the strategy of the US administration is actually to bring opportunity back home, and so domestic oriented companies could do well. But actually kind of reshoring is something that's going to take quite a long time. So I think it's also very important to remember what we think of at Capital Group as the new geography of investing. It's just recognizing that actually most of the best companies in the world today are actually larger multinationals that do business around the world. And so where they're listed, where they receive their post, that just doesn't matter as much anymore. In fact, even if you look at the S&P 500, 40% of the revenues on the S&P 500 actually come from outside the US. If you look at Europe, then you see maybe 60–70% of revenues of companies listed in Europe come from outside Europe. And what that means is that for a stock picker, really good opportunity to identify, for example, a great US or even a Chinese business that's growing quite quickly, but it's inside a European wrapper, listed in Europe and potentially benefiting from a rather lower valuation.
Yeah, I mean, we have seen some more optimism around some names around Europe, especially if you're thinking that defense spending will increase. Is that a market that you could find some opportunities in?
Yes, it is. And I'd say that's defense companies around the world, but certainly defense companies in Europe. I mean, investing in Europe at the moment, for very obvious reasons, can be quite disconcerting. Geopolitics is really in quite a swirl in Europe right now. And Europe also has some, fairly obvious challenges. It has a pretty rotten track record of productivity growth, and the workforce is actually shrinking over time. These are not good foundations for investment. However, remember also the new geography of investing, so great global businesses inside a European wrapper. But also remember that Europe needs to defend itself. You mentioned that, Cherie. It also needs to fuel itself. Actually, it's likely that in this world today, it needs to reindustrialize as well. And so that has the potential to drive really an investment super cycle. And actually, Europe has a really big industrial sector. So a lot of these companies could really benefit from these powerful secular trends.
And the Budden of Capital Group, really good to have you with us. Thank you so much for that really broad conversation on the global markets. We'll actually be speaking a little bit more about Europe. We do have coming up Jens Ruebbert of EuroCham Singapore joining us next with his insights on what's ahead for Germany's Chancellor in waiting, Friedrich Merz. This is Bloomberg. Former U.S. Treasury Secretary Larry Summers says President Trump is not only blaming the victim, but also squeezing Ukraine for compensation in his pressure on Kiev to give up a share of natural resources in any peace deal with Russia. He sees some parallels between what is happening now and also Europe's own past conflicts, specifically the Treaty of Versailles at the end of World War I.
What the Trump administration seems to be proposing, and to be fair, we have not seen all the details, is Versailles, a Versailles-like agreement imposed not on aggressors, but imposed on the victims of aggression.
President Trump deepening Washington's split with his traditional allies as he drives for an end to the war in Ukraine. The U.S. withdrew its previous stance condemning Russia's invasion of Ukraine at the United Nations, a stark policy reversal from President Biden's administration and another blow to ties with the EU. This comes as French President Emmanuel Macron visited Trump in Washington in an effort to get Europe back to the table in talks with Russia. But this exchange between Macron and Trump on EU funding to Ukraine, serving really to highlight the growing tensions.
Europe is loaning the money to Ukraine. They get their money back.
No, in fact, to be frank, we paid 60% of the total efforts, and it was through, like the US, loans, guarantee, grants, and we provided real money, to be clear.
Let's get more analysis with our senior editor, Bill Ferries, in Singapore. Bill, there seems to be a significant realignment of interests and loyalties here when it comes to Ukraine. Can President Trump achieve a deal to end the war in Ukraine without input from Ukraine itself or the European Union?
Hi. Yes, I think you're absolutely right about the widening gap between the U.S. and Europe. And I think Macron's visit to the White House on the third anniversary of the restart of the war there is a sign that Europe wants to make sure it is a part of those talks, that some kind of a deal between Donald Trump and Vladimir Putin doesn't leave Europe out, doesn't leave security guarantees for Ukraine out as well. So as we saw a lot of agreement between the two leaders. On the surface, when you parse their words, you really do see them disagreeing on this. But President Trump suggesting that a deal is getting closer by the day, that President Zelensky of Ukraine may be in Washington within a week to help sign a deal on critical minerals. And he also saying that he may be meeting with President Putin within 1 or 2 weeks. So things seem to be moving rapidly. We don't know the details of what's behind any of these potential meetings, but President Trump definitely indicating that he is looking to try to bring a close to this war as quickly as possible.
And President Trump definitely angling for some sort of economic payment out of this, right? I mean, we have seen those conversations around mineral resources and development in Ukraine. I find interesting that President Putin is offering his own deal when it comes to developing mineral resources, not only within Russia, but within parts of territory that they occupy in Ukraine. What sort of conversations are we seeing on what sort of transaction we could get alongside a peace deal?
Yeah, I mean, there have been numbers tossed out of Ukraine contributing up to $500 billion to some sort of a fund that comes from the mining and sale of critical minerals and other key assets in Ukraine. President Macron is, interestingly enough, saying that he doesn't think Ukraine should be having to pay back anyone for this, that Russia should be paying for its aggression in Ukraine. But as you said, President Putin as well trying to lure in Donald Trump, I think, with the prospect of energy deals in Russia and critical mineral development. I think world leaders know that President Trump likes to make a deal. He likes to talk about economic incentives, and Russia going very far in terms of saying, hey, there's business here for U.S. companies if we can get over the war and we can get over some of these sanctions. That is alarming a lot of leaders in Europe right now. They want to make sure they have a seat at the table for any of these discussions.
Bloomberg senior editor Bill Ferry is there with, of course, the rising geopolitical risks around Ukraine. But doing business in this environment, of course, very challenging. Let's discuss all of this with Jens Ruebbert, president of EuroCham Singapore. Jens, great to have you with us. As I said, given all of the different variables around what could happen around Ukraine, the more fractured relationship between Washington and its European allies, and just another variable that is perhaps a closer relationship with Russia as well. How do businesses plan for this?
Good morning. First of all, I fully agree with Bill. It's a very good sign that a European leader with Macron, and then Stammers is visiting Washington later this week, is a very good sign. It's always better to speak with each other rather than about each other. And there might be different opinions on how to solve this conflict, but again, I think it's a good sign that there are talks, and that's what we really highly welcome as European businesses and the European Chamber in Singapore. I think that's the most important statement. It seems to be a bit complicated, who wants to reach what, but that I think needs to be remains to be seen over the next few days, I guess.
Are you seeing any realignment in terms of business planning from your members when it comes to how they're going to deal with issues at home and where they're seeing the opportunities amid all of this uncertainty?
Well, obviously, I can only speak for the European companies doing business in Asia, but I can tell you that there was always a discussion about the possibility to that this conflict comes to an end, and of course there's always considerations of what happens after this, and in a more general perspective. Of course, I do think that European companies anticipate, some sort of business opportunities, after that conflict. Definitely, the answer is yes, and that I think will be will be seen the next few days and weeks if it really comes to an end of the conflict.
We have heard from the European Union that estimates of President Trump's steel and aluminum tariffs could cost the EU bloc's exports 28 billion euro. Are your members thinking about readjusting to perhaps other markets, especially since you're talking about European companies doing business in Asia? Where do they see the opportunities?
I think since the announcements of the U.S. administration, to increase tariffs in all kind of areas, of course there is a clear view at alternative markets, and needless to say that Asia is at the forefront here. I think there's a strong hope also that the EU is accelerating, to negotiate free trade agreements with various countries, in particular in Southeast Asia, in the ASEAN states. I think we do see a lot of opportunities, and who knows, depending on the further kind of friction between the US and the EU economically, there might be a way for the EU to look closer again at China as well. So I think the answer is clearly yes. European businesses are looking at Asia, to try to compensate for what they probably could lose in terms of business. Whereas, let me make that also very clear, I do not think that we should mix up, the political front and the business front. European businesses will still look at the US as one of the most attractive markets. So I think there's a bit of a difference between the political development and the business development.
But of course, we are really watching what's happening with Germany as well, right? Especially since we're expecting this new administration to come from Friedrich Merz. We're expecting also trade tensions with the U.S., German automakers being big players around the world. What sort of changes do you expect from that economy, and perhaps how that will help position Europe and European businesses in the next few years under a Trump administration that's more aggressive when it comes to trade?
Well, as I said, I think whatever relates to the EU is obviously relates to Germany as well. In particular, I think as an export nation, we are strongly interested in having good trade relationships with all the countries and big markets. And again, as I said, I don't think Germany or German companies will turn away from the US. I think there will be further negotiations from the political side, in particular on the tariffs, and I think German companies will try to expand their business also in the US wherever possible. But yet again, Asia is a very attractive market. German companies are heavily invested, as you know, in China, but also looking more and more at Southeast Asia. That will be certainly something for our new chancellor to also push the EU, to try to accelerate free trade agreements. Again, free trade is the most important thing for Germany as an export nation.
And what we've seen, especially during the last Trump administration from 2018, is that a lot of countries really turned inwards and more protectionist as well in response to some of these tariff threats. Are you concerned at all that might happen across Asia as well?
I don't think so. I think Asia will remain an open market. I think Asia is trying to take advantage of exactly these frictions. And again, I do see good opportunities at the end of the day. We see that various countries in Southeast Asia have started or commenced with the negotiations and talks with the EU about free trade agreements. I think that there will be no protectionism be seen in Asia, in my view. Except
Jens
China,
Ruebbert,
US,
really good to have you with us, President of EuroCham Singapore. We're running out of time, but it was really good to have you with us. That was Jens Ruebbert there. And we do want to take you through some of the movers in today's session because we have big downside across markets, especially when it comes to China. You can see in the Hang Seng Index, they're down 0.7%. At one point, seeing its worst day since November. H shares down 0.6%. It's really the tech stocks that we're watching very closely. We have heard, of course, from President Trump potentially ordering more efforts to curb Chinese tech and really expanding those chip controls that started under the Biden administration. But we are seeing some dip buyers, especially coming from the mainland, really putting on a brave face and buying the tech dip right now. That's it for Inside Horizons. Middle East and Africa is next. This is Bloomberg.